Hey guys, Czar here. I hope all is well and trust you're having an amazing week. I want to take a few minutes to walk through a brief discussion on mastering profit targets and stop losses in your day trading, which is truly a complex and fragile dance for any trader. On the agenda today, I want to cover off three things. First of all, the importance of mastering profit targets and stop losses in your trading practice. And secondly, I'll introduce some powerful foundational sample models and approaches that you can play around with in your own trading. And thirdly, I will tell you how I'm going to show each trade in my trading videos going forward in a way that will incorporate everything we're discussing today. Here we go. I think most experienced day traders understand that how they execute profit targets and stop losses are critical decisions that can determine the difference between success and failure. Yet the process is far from straightforward, and it can often confound even the most seasoned and experienced traders. So today I want to discuss a few possible options when it comes to both setting profit targets and creating a stop-loss strategy. But I will be strongly emphasizing the importance of adaptability in dynamically shifting according to market conditions. So let's start with the all-important decision of how to set profit targets. At first glance, the notion of setting profit targets would seem relatively straightforward. Just decide on the desired level of profit and execute the orders accordingly, right? Well, of course, reality is a lot more nuanced than that. The capital markets are complex machines with many moving parts, and this complexity makes pinpointing an exact profit target a rather challenging endeavor. When it comes to deciding on profit targets, traders are faced with an abundance of choices. Should you aim for a fixed dollar amount or a percentage of your investment? Should you set a single profit target or use a multi-tiered approach? Should you place your profit targets at key structures or aim to exit at certain times of the day? And of course, each of these options will come with their own set of advantages and disadvantages. So the sheer number of profit target strategies and combinations can be overwhelming. But it also gives you the flexibility to tailor your approach to your unique trading style, risk appetite, and current price action. But I do want to warn you that these degrees of freedom of choice demands a deep understanding of market dynamics and the ability to adapt your profit target strategies to changing market conditions. A profit target model that made a lot of sense last month might be suboptimal today because of things like a recent plunge in volatility or even a shift from a bull market to a bear market environment and countless other shifts and changes. Setting profit targets is a dynamic art as much as it is a science, and successful traders embrace the dynamic nature of the game, adjusting their profit targets with a combination of strategy, observation, and intuition. But having said all of that about being fluid and dynamic, I'll be sharing a basic foundational structure to start with that you can adapt as markets shift and change, and do so in accordance with your own trading approach. Ultimately, the ability to set profit targets that align market conditions with your trading goals is an art that requires practice, refinement, and a willingness to learn. I am going to show you some simple but powerful profit target models that you can experiment with in your own trading. But first, let's address the other part of the equation. Stop losses. Stop loss management is an extremely important aspect of risk management, and too many traders take it far too lightly. At the highest level, your stop loss is your protective shield that guards your capital from potential loss while attempting to allow your winning trade to have enough room to work. In a perfect world, managing stop loss placement would be super easy to understand and simple to execute upon, but again, that's simply not the case. As we already discussed, markets are dynamic and forever shifting around on a number of levels at all times. I mean, think about it. Markets are constantly changing the direction they're moving, from up to down to sideways. They're constantly changing in terms of volatility, from periods of high VIX to low VIX to gyrating VIX. They're constantly changing in terms of volume and participation, even within the same day. You've often heard me talk about the open range chaos, or the final hour of the day, power hour, and how volume and participation changes then, And then of course the twilight zone, that 1 or 2 hour period in the middle of the trading day for New York, when Europe has already closed and traders often go for lunch, either figuratively or literally. They're constantly changing and shifting in relationship to each other as well. Sometimes they're correlated with other assets, and sometimes they're divergent, and sometimes completely disconnected and floundering. But in addition to the dynamically shifting market, we also have to deal with the fact that each trader brings a unique psychological makeup to the trading game. Some traders are naturally more risk averse and are tempted to use a tight stop loss in order to protect their capital against the threat of a loss. Others are more comfortable with volatility, and they wish to use a wider stop and are able to sit through larger price fluctuations. So it will be important to recognize and embrace your own psychological tendencies and mental wiring. This is where self-awareness really comes into play. Now, if we know that the market is in a constant state of flux, we should at least entertain the notion that our stop-loss management strategy should be somewhat adaptable too. So let's take a look at some powerful sample models and approaches to both profit-taking and stop losses. First, the profit target models. My approach to day trading is called the Razor's Edge day trading model. Within the Razor's Edge model, there are sub-models that includes a set of 4 profit target models that look like this on the screen. The unit size I like to use for my model examples is 6 units, and that simply means trading with a size that can be equally divided into 6 pieces. That could be 600 shares of stock, or 60 shares, or even 6 shares. It might be 6 mini or micro futures contracts, or the equivalent idea using CFDs or Forex contracts. The first model example is all or nothing, and I'll explain what these mean in a moment. The second model is equal scale out. Model 3 is a 3-2-1 scale out. 3 plus 2 plus 1 equals those 6 units I mentioned over here. And Model 4 is the opposite of Model 3. It's a 1-2-3 scale out. 1 plus 2 plus 3 equals the 6 units. So we have all or nothing, equal scale out, 3-2-1 scale out, and 1-2-3 scale out. Now let's take a closer look at each one of these, shall we? Model 1 is all or nothing, and for this example I'm going to use all or nothing at 1R. It's 1R multiple. So in this particular case, the trader will simply enter their position, place their stop loss, place their various targets, whatever those might be, and we'll talk more about that, and then simply take profit the moment 1R is hit. In this case, 1R is hit right here, and this trader is done for the day. It doesn't matter what happens next, whether prices rally back up and take them out of this short position at a loss, or if they continue on down. In this case, prices continue down, but this trader doesn't care. They're in it for a 1-to-1, and they're done. Now, the all or nothing model, by the way, could be 2R all or nothing, in which case the trader would exit here. It could be 1.5R all or nothing, or 3R all or nothing. You get the idea. For this example, I'm using 1R all or nothing. This particular trader, they understand that they simply need a higher than 50% win rate in order to have a profitable business practice. The next model is Model 2. This is the equal scale out model, again using 6 units. So in this case, the trader will take 2 units off here at target 1. This happens to be 1R. They will take another 2 units off at target 2, and they'll take the final 2 units off at target 3. And the trade is complete for the Model 2 trader. Now, Model 3 is a little different. It is a 3-2-1 scale out model, in which case the trader will scale out 3 units at target 1. They will scale out 2 units of their remaining units in target 2, and they will scale out 1 unit at target 3, and then they are done. So the biggest portion is taken off in the beginning of the trade or early on in the trade, fewer units at target 2, and the smallest number of units at target 3. Model 4 is the opposite of Model 3. Instead of 3-2-1, it is a 1-2-3 scale out. In this case, the trader will take 1 unit off only at target 1, they'll take 2 units off at target 2, and they will take 3 units off at target 3. So it's a back-end weighted system, where the largest number of units are taken off in the most profitable position. And here they are in one single table so you can compare and contrast them side to side. We have 4 very different ways to think about profit taking each time we enter a trade. Again, model 1 is all or nothing. In my example, I used 1R all or nothing, but it could be 2R all or nothing, or 3 or 4 or 5R all or nothing. You get the idea. Model 2 is the equal scale out. 2 units at target 1, 2 at target 2, and 2 at target 3. Model 3 is the 3-2-1. So 3 units at target 1, 2 units at target 2, and only 1 unit at target 3. Model 4 is more aggressive, is the opposite of Model 3. It's a 1-2-3 scale out, so only 1 unit is taken at target 1, 2 units at target 2, and 3 units at target 3. So now let's move to the other side of the equation, from profit targets to stop loss management, the protection side of the equation. And as you can see here on the slide, I want to cover off 4 simple but powerful approaches to managing stop losses. The first is leaving the stop in place with no changes. The second is to trail the stop to break even and leave it where it is. The third is to trail the stop to target levels. And the fourth is to trail the stop to pivot levels. Let's take a look at each of these in more detail. The first one is leaving the stop in place with no changes. In this instance, very self-explanatory. The trader simply places their original stop and they don't move it for the life of the trade. The trade may come back and stop them out, or it may advance and hit any or all of their profit target levels. The second method is to trail the stop to break even and then leave it there. In this example, the trade advances to 1R and the trader decides to move their stop from original to break even and simply leave it there for the life of the trade. Prices may come back and stop them out at break even, or they may continue to advance through their target levels. The third approach is to trail the stop to target levels. This one's a little bit different. In this case, the trader places their initial stop as normal, but as the trade advances to, say, target 1, the trader may move their initial stop to break even. If the trade advances to target 2, they may move their stop to target 1. If it moves to target 3, they may move their stop to target 2. If the trade moves to target 4, assuming they have a target 4, they may move their stop to target 3, and so on and so forth through the life of the trade. And then finally, the fourth model is to trail the stop to pivot levels. In this case, the trader sets their initial stop as normal, but then as the trade advances and then pulls back again, for instance, in this example, the trader might shift their stop down to above that first pivot that you see here, for instance. As the trade advances even more and then pulls back and creates another pivot, the trader may move their stop down to above that pivot level, and so on and so forth through the life of the trade. So as you can see, once again, when it comes to stop losses, you have plenty of choices. You have lots of them. Any combination of these, as a matter of fact, can work as well. And this freedom of choice, when it comes to both profit taking and stop losses, allows you to truly customize how you approach the markets and your trading based on your own nature, temperament, mental wiring, risk aversion, or risk tolerance. So how can I incorporate all of these concepts into the trading videos that I post on YouTube each day? Well, I can't think of a perfect way to do it that will satisfy everyone, but I am going to try the following approach because I think it's the most practical way to do it. When I enter a trade, I'll simply place my trade marker showing 3 distinct profit targets and my stop loss level, as we discussed today. I will also decide on my R multiples for those targets based on current trading conditions and all relevant factors, and I'll explain those things each time I trade. From there, we will watch the trade play out and discuss how each of the 4 basic profit-taking models would have done, and also see how some of the stop-loss management combinations would have performed as well. In short, my trade videos will no longer be about how I personally traded the setup, but rather about how you could have traded that setup using the models we covered in this session. For those who are newer to the channel and are interested in exactly how I trade, you can study over 600 videos on my YouTube channel showing exactly how I do that in explicit detail. Now here are a few examples of how I will show my trades going forward. In this first example, this trade will be recorded as a 1.5R winner. And that's because prices advanced to my target 2 or 1.5R in this example before coming back and then stopping out later on. You can't see it on this chart. But what you will notice is that the target 1 all or nothing trader profited fully on this trade. The target 2 all or nothing trader profited fully on this trade, and the scale out traders also benefited as well. We haven't even discussed the idea of moving stops to break even, which I will do in each video. In this example, this trade will be a target 2 or 1.5R winner because again, prices advanced to target 2 or 1.5R before eventually reversing back up, which again, you can't see on this chart. In this third example, this will be a 2R winner. Prices advanced to my target 3 or 2R win before rallying back and eventually hitting the original stop loss. In this example, this will be a 1R winner because prices advanced from my entry to 1R before rallying back to my original stop loss. The target 1 all or nothing trader profited fully. The scale out trader was able to take some profit on this trade and potentially move their stop to break even or any combination of those elements. In this example, this trade will be recorded as a 1R loser because prices failed to advance from my entry to target 1, never reached target 1, simply fell back and was stopped out at -1R. So ultimately, my goal is to teach these concepts in a way that my group members and other followers can apply in the most practical way. And my approach to doing this will continue to evolve as I evaluate how easily traders are able to assimilate and use the information. I hope you can see the critical importance of mastering profit taking and stop loss management. Trading strategies are not carved in stone. They're polished through experience over many market cycles. By experimenting with different profit-taking models and stop-loss strategies, and by adapting to changing market conditions, you can begin to discover what works best for you. I'm not at all suggesting that you should use a different model in every trade, or even every day or week or month. But I am encouraging you to develop the ability to adapt as conditions change over time. Your initial approach to both targets and stops may be rooted in theory, but over time it should transform into an intuitive response to market dynamics. The more you engage with the market, the more finely tuned your strategies will become, and you will soon begin to align your trading style more seamlessly with your own psychological framework. Thank you for watching, guys, and for clicking that like button so that more people can hear this message. Take care. We'll talk soon.